Hello and welcome to the Netflix channel. My name is Eric and today we're going to be talking about how debit spreads work. Now in our example here we're going to be using Apple as the ticker to trade. We will be looking at a debit spread as a strategy for trading this and talking about the mechanics of how this trade works. So as we can see here, we're looking at a chart of Apple on a daily chart. And currently price is trading at around 256. A debit spread works much like a standard put or call, where you'd buy just a straight put or call, but has some unique advantages in that we can mitigate volatility and offset rapid time decay. So in this example, we want, if we're going to do a bull call spread, we would want price to proceed from where we're at higher, maybe to the 260 level or 262 level. And we would structure a trade that would afford us some time for this price to move up into here and not suffer a lot of time decay. So let's look at what that looks like. This is the Thinkorswim platform. So we're currently on a chart. If we moved over here to trade, we'd be looking at different expirations for Apple. And because we're trading what's called a vertical, which is what a debit spread is, we'd want to click on that so that when we open up these expirations, we're able to see what strikes we're going to deal with. So if we're looking at Apple here now at 256, and we think Apple's going to eventually get up here to 260, 262 or higher, but it's probably going to take us, say, 5 days or 6 days to get there, then when we come over to the trade tab, we would look at the expiration dates that we have and the number of days till expiration, and we would choose one that's suitable for that time frame of Apple getting to those prices of 260 or higher in a time frame that we think is reasonable. So if we think this is going to take place over the next, say, 2 weeks, then if we go to our trade tab, we'd go out at least 13, 14, 15 days, maybe even choose the monthly strike here. We would open it up. We would find a current spread that is either in the money or just slightly out of the money. For this example, since we're going to do a bull call spread, debit spread, we're going to click on the 257.50 by 260, and it will bring up our example here. We'd be buying the 257.50 and selling the 260. The most that we would pay is $1.33 about, which is where it's currently trading. And that would be a debit with an anticipation that at some point we would close it higher. So meaning north of $1.33, and whatever that difference is between what we closed it at, let's say it closed at $2 and we spent $1.35 where it's currently trading, we get to keep that difference, which would be about $65. Now, the idea with the debit spread is to get in and make a decent return and get out, not necessarily hold it to expiration. So because we have 22 days, if we can see price move from here up to close to 260 or higher, then our spread's going to be moving up in price as far as the amount we would get to keep from where we're currently paying for the options to put on. Now we have something working for us because we're long one option and we're short another. So we're paying this premium, but we're collecting this premium. And that's how a debit spread works. We also get to mitigate volatility because right now, with the VIX being high, we're paying a higher premium in our options. If we were to just buy a straight call option, we'd be paying a little higher premium than we would if the VIX was not high. But because we're buying one option and selling another, that's kind of a counterbalance. So it mitigates the fact that we're paying up for a call in one direction because the call that we're selling, which would be in the other direction, is also affected by volatility, and the premium for both are high. So we're effectively mitigating volatility by buying one and selling another. And now what we need for this trade to be successful is the price to move higher over time within our 22 days till expiration so that we can exit this at a price higher than what we're paying for it. So if it stalls along the way, that's okay. Again, because we're long one and short the other, we get to offset some of that time premium that we paid while being in this trade waiting for it to go north. Now, we can recognize a full profit if by the time the 22 days comes around, we are north of 260. In other words, we're trading above that because this is $2.50 wide and we're only spending $1.30 as the current debit. That difference of $1.20 is the full maximum return that we could realize on this debit spread. Now, we're of the opinion that we don't hold it till expiration. If we can see a 30% return or higher or any kind of return based on how quickly this moves up, then we could exit the trade and look for another opportunity. So we don't necessarily hold it till full expiration. We'll take a partial profit and close it early so we don't have to sit on it for 22 days. Maybe only sit on it for 2 or 3 or 4 days. But buying us time because it's so far out will help us have a better chance of seeing a return as price moves up. We're going to be looking at debit spreads, specifically a bull call spread and a bear put spread. We're currently looking at a daily chart on Apple, so we use Apple as our example here. If we flip over to the trade tab, we will find that we can type in Apple, find an expiration date that we would like to trade out to with our debit spread. So let's just, for this example, look at the 1st of April, so 6 days away. If we open it up, we'll notice that we're on a vertical. And if we drop down to the strike prices, let's say we wanted to put on a bull call spread, we'd be looking at prices about at the money or a little above. Let's choose one that's just above, 257.50 by 260. If we click on it, we can see that we've formed our trade, wherein we're buying the 257.50, selling the 260, and we have a net debit here. Now, when we click on confirm and send, we see the summary of what our maximum risk is in this trade. If we believe that Apple's going to go down, we would come over here on the put side and again find strikes that are at or below where price is currently trading. If we say look at the 255 by 250, meaning that we anticipate price to move down below 255 towards the 250, we would buy the 255, sell the 250, and that would create a debit spread that would expire in 6 days. Now, each of these are used, of course, in anticipation of a biased move, and that is how a call bull debit spread is formed or a bear put debit spread is formed. If you're interested in learning about profiting from our option strategies, click on the link below.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPic's full risk